Hey, before we get started today, I want to talk to you a little bit about getting ready for retirement. Those few years prior to retirement are very crucial, and so many people are headed toward retirement destruction. They're not taking into account inflation, their allocation in their portfolios, their cash flow, or the debt that they carry. So much so that our team here has put together 5 steps to have financial success in retirement. This is a free download. It's on our website. You can go to wiserinvestor.com. At the bottom of the page, download 5 steps to have financial success in retirement. Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
How's it going?
Hey, so we're going to continue our series on 5 steps to have financial success in retirement. This is a free download that's available on our website, and we're breaking that up into our podcast series for this month. We are on step number 3 now. We've already covered managing cash flow in retirement, as well as building and maintaining cash reserves in retirement. This is probably one of my favorite topics, is step 3, which is maintain investment discipline. So many times we don't see investment discipline, which quite honestly is why people that use, I would like to say just us, Brad, but reality, people that use financial advisors in general have a higher rate of return, right?
Yes, they do. And studies have shown this and borne this out over and over and over again. It's really the discipline that is required for investors to stay invested throughout times that are good and times that, aren't as good. But it's put together with a total financial plan. The investment portfolio is part of it, and it's a very important part, and we take that part very seriously here.
What's interesting is no matter who we sit down with, especially me and Matthews, we're doing a lot of the planning here. If you sit down with someone and they have $10 million, it's all they got. If you got $300,000, that's all they got. And the $10 million person doesn't think they're wealthy at all, right? They just think it's normal, and as well as the $300,000 person. So it's understandable how we make irrational decisions with our money.
Well, it's because emotions get involved with money. So it's one of those things. Maintaining investment discipline is simple, but it's not always easy to do because your emotions get in the way. You might agree to something or understand what you need to be doing, but when that is your livelihood and the way that you're going to live in retirement, sometimes emotions get in the way and can get the better of you.
Yeah, well, not just with money, but just other things too. I kind of have a rule of, if I know that it's an emotional decision, I step away from it for a couple of days, and then I'm able to look back more rationally and make that decision, because you don't want to make emotional decisions.
Especially not with your money. That's your long-term serious money in retirement. That has to be a well-thought-out process. And utilizing a financial advisory firm, especially one that's fiduciary-oriented, is a great way to get good advice that's in your best interest.
The second thing people say when they come in is, remember, this is all I have, and I only want to make money. I never want to lose money. And some people know that that's not necessarily possible, so it's not possible at all.
If it's too good to be true, it probably is.
And they laugh as they say it, but they're laughing as they're really telling us what their fear is.
They are. There's a grain of truth in that statement for them. When they share that with us, they're actually saying, I am fearful of downturns in the market. I don't know what that brings to me and what that means to me, and I'm afraid of it. And they're letting you know in maybe kind of a half comical way. But when we hear that, we perk up. We know that we have a discussion about long-term investing and maintaining investment discipline at that point.
So there's that nervous laughter, but there's also the very confident person that comes in. They're not confident in their ability. They're confident in our ability to be able to sell at just the right time and buy back at just the right time. And I feel like I let them down every time I talk to them, is saying, maybe we can once or twice, but we can't forever. We're going to be wrong, and we're going to undo all the good things we did. So that's not a good way to invest.
No, it's not.
It's short of Vegas.
Yes, it's a little speculation there that's required. And, I've done some research on this, and we've gone back to the early 2000s, where we saw the great financial crisis and what that did to the market. And then again, here recently with the global pandemic that's occurred. These major shocks to the market occur from time to time, and it's really how you react to them that makes a difference in whether you're going to have a successful investment program or not. Casey, you just shared with us that, people ask, to us to sell at just the right time. So if the market was high, back in October of 2007, and then went down 51% by the time it reached its low in March of 2009, if they had sold that back then and waited until the market recovered and then purchased it back in with their investment portfolio and then held on to that for as long as they could, which was to the point where the global pandemic hit, and then they got nervous and sold at the low of it where the market had dropped 34%, and then waited till the market came back to its high again and invested, and then rode that till now, they would have had a 31% return. However, for the person who just rode it out the entire time, back from October of 2007 through the great financial crisis, through the global pandemic, they'd be sitting on a portfolio that had earned 170% if they had invested $10,000.
If they had done nothing.
If they had done nothing, that's right. If they had just held on, if they had maintained that investment discipline. Now, we talk about being long-term investors, and it sounds at point, people can hear this over and over, and it even sounds somewhat cliche, but there's a reason we are. Our investments are real companies. They have real products and services, and they have real cash flows that are produced by those companies. Every time the market goes down, it grows back higher and faster than it did before. And there's reason for that too. Our corporate executives, they learn from these experiences. They become better managers after a crisis. They become better stewards of shareholder capital each time. So these market downturns are really not something that should be feared. They're not pleasant. They're not enjoyable to see your market values go down. But having faith and maintaining discipline, we should know that the investments come back better and stronger than they did before each time.
Sometimes doing nothing, it seems like nothing, is the hardest part.
It's a choice,
but
though.
we have about a third of our client base that are airline pilots. And I have a background in aviation as well. And what I always tell them is, there's this training. You go through training. They call them V1 cuts. V1 is the speed at which you're not going to stop. You have to keep going because you're going to run out of runway on the other side. You never want to abort a takeoff past your V1 speed. And your V1 speed's based on weight and temperature, and it's different for each flight, right, in each climate. So we have what they call V1 cuts in the simulator because as soon as you pass V1 and you start rotating, the instructor will, in the simulator, of course, will cut the engine off, one or the other. And what's interesting is the first thing you do, obviously, is you keep flying the airplane, but you don't just start swinging for levers and buttons, right? That engine, if it's on fire, is designed to just fall off the airplane. We saw this on the United 777 flight out of Denver several months ago. What happened? The engine just disintegrated and it just fell off the airplane, landed in somebody's backyard or field or something, right? It's designed to do that. What you don't want to do is if you've lost an engine, what you don't want to do is cut off the wrong one. That's happened in aviation, mostly in Asia. But that's happened in aviation before where they take off, they lose an engine, and then they just start reaching for stuff and they shut off the good engine, and now you have airplane with no power, right? You have to take time and think and analyze. And there's a QRH. You pull that up, you read that, you go through the steps, and you confirm with your co-pilot, shutting down right engine, yes, or right engine failed. There's a procedure for that. I'm 5 years removed from a commercial cockpit, so I'm not. I have to go back into my memory to pull that up. But the point is that there's a procedure for that, and sometimes the best thing to do is monitor. It's not that you're doing nothing, you're just monitoring. And that's what people don't always get because they get emotional about it and they go, oh, I got to make a change. And so what they've done is they've just cut off their entire savings from being able to do anything. They have no power because they're in cash. They're not flying anymore. They're sitting on the sidelines. In the meantime, the market keeps going up, or it might keep going down. They feel like heroes at first. Right? They shut that good engine off and they go, oh, okay. There's no sound. Oh, wait a minute. There's no sound. That's not good. So that's an airplane analogy. Another thing too, is, if you use a car analogy, you're driving down the road and you have no plan. You're just driving, right?
Yeah.
It's like, well, I didn't like that direction, so I'm going to go this direction. I don't know where it goes. You have to be rational about things. But what's interesting, and I wish this was more prevalent in my undergrad, which was behavioral finance. Schiller up at, what college is he at? Is that Princeton or Yale?
Robert Schiller?
Robert Schiller, yeah. I can't remember. You can look it up. But the point is that he has a behavioral finance class, which I was able to audit through what used to be Apple University. I don't think they have that anymore. But you could audit different classes. And I really liked that class.
They're adding it to the CFP I saw as another course too. So it's become more prevalent, and it's obviously becoming big enough to start putting on exams like that as well.
Yeah,
well,
it should.
We're talking about behavioral finance, and this has really become something since the early 2000s when Daniel Kahneman won a Nobel Prize for behavioral finance. Then it was followed up by Robert Schiller earning another one, and then Richard Thaler won a Nobel Prize also for some of the things that we're going to talk about. And that's directly, our biases towards investing. As an investor, as an individual investor, we have bias. We come to the markets with preconceived notions.
Well, there's some really 6 patterns of irrationality, we'll call them. And I think we should go through these. I think our listeners you might identify as a listener with one of these, and that's fine. It's human. This doesn't mean there's something wrong with you. It just means you're normal. But you have to fight that. First of all, is overconfidence. Sometimes I call this the water cooler talk. But overconfidence basically is just rating oneself above average when it comes to selecting investments. So you are an optimistic person and you only talk about those winners that you made, the Tesla and the Google, but you don't ever talk about the Enron. You've just blocked it out of your mind.
The water cooler and your neighbor who's telling you about all the hot stock picks and how well they've done.
Or the brother-in-law.
But the other thing about overconfidence is that when people have that, it's because they may have selected, as you said, an investment or two, but they're not talking about their entire portfolio, which is what we do as investment professionals. We look at the entire portfolio, okay? So you may have an investment that did well, but depending upon the allocation you had to that, depends on whether or not your overall portfolio did well. We tend to select that one investment that may have done well at any given time.
Are you only focused on the upside? You don't think about the downside? You're miscalculating the probability of a good outcome.
Right.
And you're de-emphasizing the potential downside of investments. Probably a good example of this would be emerging market stocks. If you look at the data from 2005 to 2020, this is a Morningstar report that we generated. You look at emerging market stocks, starting in 2005, we had a 35, 32, 40% rate of return. But then we had, in 2008, we had a 53% decline, followed by a 80% increase in 2009. Right? So it's very volatile.
That's the definition of volatility right there.
2011, it was negative 18%, and then we were up 18, then we were down 2, down 14. So I could go on. It's hard to pick this if you're just listening, but the bottom line is that you have to average all that out, and you invest in emerging market stocks because it has a high rate of return would be a false perception of what emerging markets is currently and has been in the past, right?
Yes.
So that's something that you definitely want to stay away from.
You can see overconfidence as well in your own individual stocks for your company's stock options. A lot of times people want to think they know more about their company than everybody else, and they think that my company's never going to struggle. So overconfidence can happen with your own stock options as well. Not only you become highly allocated to your own stock, but you just think that it's always going to continue to do well. And as you mentioned, that's not always going to be the case.
Right, absolutely.
And we see that often in concentrated positions in portfolios where they've accumulated company stock over a number of years, and it's done well for them. And they believe that that's the way to invest a portfolio. It's a way to grow wealth over time, but then you need to diversify away from the risk of a single stock.
I see this next one quite a bit, hindsight bias. That's simply believing that unpredictable past events in retrospect were obvious and predictable. So you have people who write books about this who are claiming the next financial crisis or the next real estate crisis, and they're very negative. Eventually, they're all right, and they say, "I told you so," but they would have you in cash for 2 decades.
Yes.
The entire time waiting for doomsday to come around the corner. But obviously the technology bubble and the real estate crisis are probably the two most common hindsight biases, to where they're looking in the past going, oh yeah, it was obvious that wasn't going to last. And at the time, in the middle of it, it wasn't. It's probably irrational exuberance at the time. And we you probably knew that this can't go on forever, but it doesn't mean it was predictable.
That's correct. And it just becomes so enticing to invest in that it keeps moving the markets forward, by new investors constantly buying into it. But to say that, you saw it coming, it's great afterwards. And newsletters, investment newsletter editors have made a fortune off this. Like you said, keep predicting. And eventually they do become correct.
You'll be right at some point if you keep predicting doomsday.
That's the old saying that even a blind pig can find an acorn from time to time.
Brad, you and I are down at the financial or the ETF conference down in Boca. Do you remember that guy who came on and talked about how the portfolio should be changed to be like, he wanted mostly gold, silver. He wanted to have inverse funds, meaning if the market goes up, you make money. Do you remember that guy? I don't know if you were in that session with me. He was in the main session.
Was he?
Well, he was in the main session. I don't think it was a main session, but he was in that big room.
Yeah.
So many people were just taking notes. I think back about that. It's like, man, if I'd come home convinced that this guy was right, and we changed all of our portfolios to what he was talking about, and I mean, very well attended. There were 2,000 people here. I'd say there's at least 1,000 in that room.
Everybody wants to know about the next great investment.
That would have been bad. It would have been so bad if you had listened to that. But yeah, they hired this doomsdayer to come in, and I kind of look at it as entertainment, honestly. At this point, even then, I started going, oh man, I'm getting anxiety just sitting here listening to this guy. All these bad things that could happen to these portfolios, and we're in charge of so many families here. And then I realized, no, he has something to sell. And it's a newsletter. It's a whatever, And he's using fear to move that. And as soon as I got that right in my head, I was like, okay, this guy has his own agenda.
Well, that's why investing, for us here as a fiduciary, we're not looking at hindsight. We're forward looking. We're looking at long-term capital market assumptions based upon the current environment and what our expectations are for the future. The past is the past.
Right.
There's nothing we can do about that.
Well, that's a great segue, because the next one is short-term focus. I always tell people when they're investing, relate it to walking down the street. When you walk down the street, you don't look at your feet. If you do, you're going to run into a pole. You're going to trip over something, right? I mean, you have to look out. You look out the same way. You don't drive a car by looking at the hood. You drive a car by looking out, and that's how we have to invest. A lot of people say that they're long-term investors, but they make short-term moves.
That's right. Throughout our working careers, we look at our income every 2 weeks or every 30 days, every month, or whatever the case may be. And that over time kind of creates a pattern in us as to that's our time frame. If we're living paycheck to paycheck, that becomes our time frame. Whereas in retirement, your time frame is 10, 20, 30 years out. And you should be just as worried about that paycheck 30 years from now as you are for the next one. And by being a long-term investor, what you're doing is you're taking care of that paycheck today and 30 years from now.
And you mentioned it before about just staying invested through the long term, through those great financial crises. The thing people forget is they try to time back and get back in the market is that the biggest returns happen after the biggest losses. So if you're missing those pullbacks, if you missed the 10 best days, it said that you missed 33% of possible growth in your portfolio. And if you missed the 20 best days, you missed almost 50% reduction in the portfolio growth. So it's important to realize that even if you think you can time the market, that those biggest returns you've probably missed when you're trying to get back in.
Morningstar has a study. They showed investors only 1 year returns, stock market returns, and then asked them to choose a portfolio. They when looking at 1 year returns, they chose to put 40% of their money in the stock market. When looking at 30-year returns, they put 90%, right?
Yeah.
Because they see, that's almost guaranteed.
Yeah.
It's not guaranteed, but it looks guaranteed because it's never lost money over 10 years. So they're focused out. But when you look at a 1 year time span between 2001 and 2020, there's a 45% chance that you're going to lose money on a daily basis in the stock market. Over a month, there's a 34% chance. Over a quarter, there's a 28% chance. Over a year, there's a 20% chance. So it goes to show that you want to invest your money way more than a year. In fact, here, if someone comes in and says, I'm building a house and it's going to be done, should be completed in 4 years, meaning that's when the final payment is, we don't invest that money. That money is going into something very secure. You want to be invested for 5+ years, and you want to be that way until you die. When are you going to die? You don't know. So therefore, your portfolio has to work for you until we use it in age 95. So you have to focus long term, not focus on the short term moves. But that's what people do. People go, oh, I feel like, first of all, they go, I'm tired of losing. Because none of us wants to be losers, right?
Right.
So I'm tired of losing, so I went to bonds or I went to cash.
That's called capitulation in the market. And that's usually the final end of a bear market, is when investors capitulate. They've just ridden the market down for so long. I can't take it anymore. Good one, Casey. Absolutely. And when that happens, that's about when the market's going to turn. So what does that mean? That investors, by the time they capitulate, they are going to sell their investments at what is going to probably be the market low,
right?
Which is the worst time.
Absolutely,
yeah,
absolutely. That Matthews, I think your first week here was with a family that I challenged on liquidating their portfolio at the bottom of COVID. You're probably a little nervous that week that I would talk like that to people, but I'm so passionate about our clients winning. I couldn't let them succumb to them. To their emotions and selling. Yeah,
I mean that was probably one of the tougher ones there. We had a 30% pullback in a couple weeks in a month. So,
and for the record, they're still here, but they didn't even let me do the review meeting. I think you did the review meeting, and their comment was, "How come our rate of return's less than the benchmark?" And you're like, "Well, it's because you chose to sell part of your money."
Exactly, all timing. I mean, the market has doubled since that time, so there you go.
It's a great family. I love them dearly, but they just succumbed to the emotion of what was happening at the time, right? And what happens is we mix in our politics with it, because we mix in, they didn't like President Trump at all. This was a train wreck, right? And so you mix in the politics into it, which really has nothing to do with it.
It happens right now, and it's definitely happened right now. You hear that from the other side of it.
Yes, you hear it from the other side. That's right.
A doomsday scenario with the world's ending and what's going on with the
I remember when it was Trump and Hillary running, and half the clients here said, how do I Trump-proof my portfolio in case this crazy man wins? And then the other half was, how do I Hillary-proof my portfolio in case this crazy woman wins? And the bottom line is, as an indexer and buying everything and managing funds like an endowment or a pension fund would, it doesn't matter. It doesn't matter. Now, if they kill capitalism, that's going to matter a lot more. That's why I was more worried about Bernie Sanders, the anti-capitalist. But
that'll be an interesting podcast if it happens sometime.
Yes, absolutely. I see this one occasionally, regret. That's having feelings of guilt because of a poor outcome. I met some people like this, I think, after the financial crisis. I'd say we went a year of meeting with people who used to have $1 million in their portfolio, and now they had $500,000. And they had regret in their decision to liquidate the cash, but they didn't know what to do and didn't know how to get back in, so they sought out a professional. I hate to see that, and we have techniques that I work with them to work through that regret. So we have to address that before we can move forward in a healthy manner.
Yeah, we saw a lot of that during the great financial crisis, because the runoff, took about 17 or 18 months, and people held on and sold, held on, some sold, some held on, some sold. And by the time it got to the market bottom, people had begun capitulating, as we talked. And those are the ones that had the most regret, because they saw the market go back up and they were too terrified to get back in.
Yep.
Yeah. So.
Yeah, I remember a good friend of mine, Gary Kitchen, passed away last year. Miss him dearly. He's a great golf buddy of my son and I. And I remember Gary at the bottom. Was it like March 15th, something like that? March 23rd, I think, wasn't at the bottom of the.
It was in March of 2009.
March of 2009.
Oh, excuse me.
The Haynes bottom. He was like, get me out of this market. And I basically told him, I said, look, I work for you. I'll do it. But you're also one of my best friends. I said, you need to drive over here and hit the enter button. I'm not going to hit the enter button.
Yeah.
And he's like, if you're that passionate about it, then we'll leave it alone. And thank goodness that's not what happened. He held on and had a great retirement, and unfortunately checked out earlier than most of us would like. So if you're dealing with regret, you just have to forget about the past and look at the resources you have now, and you have to move forward. That's really how you work through that. Mental accounting, see this all the time. Mentally compartmentalizing investments while ignoring the aggregate portfolio. You talked about that earlier, Brad.
Mm-hmm. Yep.
We only think about the winners. Yeah, we had a person in here not that long ago that said he fired his financial advisor because he could pick stocks better, and he bought Avis along with the whole the meme stock fiasco is what I would call it, but the meme stock mania. And he made a lot of money on Avis, and he fired his financial advisor. And I said, well, what about the other picks? How they performed? He's like, oh no, I lost money on all those.
We got great returns on one or two.
But we got great return on that one stock, right? And I knew right then probably not a good fit for Wiser Wealth Management. But we tend to have that bias. The mental accounting and hindsight bias, I feel like are somewhat similar. But you do have to take a look at the total return of your portfolio, not just the few stocks that did really well. Hot hand fallacy, perceiving trends where none exist and consequently taking action on this faulty observation. It's like random chance. It's like what it really is.
It's like Vegas.
It is like Vegas.
This is the gambler syndrome. Okay, not that they're a gambler, but this is a syndrome that occurs in Vegas where someone will go to Vegas and they'll start playing roulette, or they'll start playing some other Wheel of Fortune game, and if they win from time to time, they feel like they've got the hot hand, that they're going to keep going. Now, the casino is on the other side of this, and sometimes they lose, to the gambler, and that's all good and fine, because the casino knows that over long periods of time, the gambler is going to lose money, because the house is always going to win. The odds are in the house favor. The hot hand fallacy is just the opposite of that. It's the gambler who thinks that I've got a hot hand, I'm going to win forever. The house knows that the house knows that that's not going to happen. So the question is, do you want to be the gambler or do you want to be the casino?
And this speculating happened a lot, obviously, recently with those meme stocks you mentioned, Casey, as well as certain crypto investing as well. So they had these outrageous returns and kind of speculate that would happen forever until it doesn't.
I think they should add one. I mean, these are the ones that are written about and studied about, all these different emotional reactions to investing. But they should have one called media bias. Not that the media is biased, but you yourself watch CNBC and you see the markets are down 30% or 20% or 10%, and you assume that your portfolio is down the exact same amount. And that's not normal. If most retirees, you're going to have a 60 stock, 40 bond allocation, or a 50-50, or maybe 70-30. That'd be pretty aggressive. So you're not participating in everything that you see on TV. It's diversification is the key. You got to have a mix of bonds and different types of stocks and real estate inside the portfolio. So everything should be moving independent of each other. Stocks are kind of blend together, obviously, but they have different rate of returns.
Right.
Over the last year, small cap stocks have a much different rate of return than large cap stocks, right? So you have to maintain diversification in order to help you maintain the discipline. And there's some tests that you can take. We have one we use with our clients here to determine risk tolerance. But in our planning software, we also talk about during the financial crisis, this portfolio would have lost, and it tells you a dollar amount.
Right.
Which is different than a percentage, because people don't think in that terms. They think of how much did I actually lose to my wallet. And
you had $2 million and you lost $800,000. Oh my gosh, I couldn't handle that. Okay, great. Let's look at this model. And then you show them the loss of upside. Okay, well, you also would lose this amount in gain going forward, right? So you have to pay attention to that as well. I'm more of you put someone in a portfolio that's appropriate for them, and then you have to be willing to hold their hand. So we know the people on our client list here that are the nervous Nellies, and if you're listening, we care about you, and we reach out to you more than we do the people who are rock solid, right? We reach out to everybody through our email communications, but I try to pick up the phone and call these people if we're in times of crisis, right?
Right.
Because I know it's right for them going forward, and they may just need some hand-holding. But then there's also people who cannot stomach volatility. And so that's a challenge in this portfolio environment.
You mentioned the 20% drop if they're participating in half the market with the 60-40. I mean, that's really only a short-term blip if they sell. So you only realize that loss if you sell. You invested long-term, it's not really an issue, but it comes back to behaviors and that it's tough to stomach watching your portfolio drop like that.
It all goes back to planning.
It does. The portfolio has to reflect what's occurring in the plan. The portfolio is simply a way to implement what you want to accomplish financially in the future for your life. So we match the portfolio to the plan, which has brought out what your goals and objectives are. So it's what you have and what you want and when you want it.
Yes, and there's a purpose.
With a purpose. That's
so
right.
You know that this portfolio is going to last their lifetime. And you know, maybe we make tweaks to it along the way based on interest rates and other outside factors. But the important part is that you got in the car and you know exactly where you're going, and maybe the road's closed and you have to make a detour, or maybe it's just bumpy for a little while, but you understand what the objective is. That's why it all has to start with planning. You can't work it backwards. You can't go and find an asset manager and say, I need this money managed. And they're going to ask you some basic questions on risk tolerance, but that's not a plan.
No, it's not.
It's
not.
So you're able to get through this if there's a plan. There's a risk on getting in an airplane and taking off and losing an engine at rotation, but if it does happen, there's a plan. It's all written out. You reach down, you grab this book called a QRH, you turn to engine failure in flight, and you start going down this checklist. And if they go through the checklist in the right order, everybody lives, right? It's the same way with portfolio management. It's risk management. There's a checklist for this. We get through it. All the portfolios survive. Everyone's better off on the other side. That's how you have to approach it. But in the middle, it's scary, because if your house is on fire, what do? You run out. You call someone. You take action, right? Sometimes the best thing in portfolio management is not to take action. It's kind of a crude comment, but I say, if you have a spouse, it becomes irrational. You don't argue with an irrational spouse. You just walk out, right? You just we'll have this conversation when everyone's calmed down, right? And sometimes you don't want to trade into an irrational market. It just doesn't make sense, right?
Yes, that's quite an example. The airline analogy is great here, because it's not unusual that, the external forces that the pilot is facing, wind, shear, require the pilot to continuously make small course corrections, right? Well, that's what we do in portfolio management. We make small course corrections. We do rebalances. We look at the valuations in different asset classes to see if we should underweight or overweight them from time to time. Those are just small course corrections. We maintain the allocation. If it's a 60-40 allocation, we're not changing the allocation. We're simply changing the asset tactical maneuvers inside the portfolio. So it's the same idea, and the analogy works very well, I thought.
Honestly, I think we could just keep talking for hours about this, because we're very passionate that financial success comes from a well-diversified portfolio, keeping the cost as low as possible in the portfolio. You want to have a portfolio that costs you less than 0.1%. In this environment, this market, everyone's competing to be the cheapest, and everything trades for free. So your portfolios are almost free these days. And then you want to maintain investment discipline. You want to execute that plan going forward with precision. You want to rebalance at the right time, right? You want to choose when you sell stocks and bonds. Never do that out of fear. So that's something that is very easy to do, because we have processes put in place that force us to do that. In the middle of a crisis, I promise you, we are all human here, and we all probably take our turns going, maybe we should just go to cash. And then someone here, this is the benefit of a team environment, someone here goes, no, that's not what we do here. We maintain discipline, right? It's hard. I think it's harder for DIYers, because they get nervous and there's no one to talk to.
That's right.
But just remember that if you have a well thought out and prepared plan, that when the emergency comes, it's much, much easier to get through it, because by looking down the street, not at your feet, that you're going to be successful. So let's go ahead and end this conversation, guys. That was good. Our next podcast is going to be on avoid carrying debt. I am just as passionate about being debt-free as I am about maintaining investment discipline. I think it's important that you can maintain investment discipline because you are debt-free. There's less on the line. And this varies, between families and net worth. There are exceptions to that. And we'll talk about that in our next podcast.
Look forward to it.
Thank you.
Enjoyed it, guys.
Thanks for listening to the Wiser Roundtable Podcast. We hope you enjoyed it. Make sure to subscribe wherever you're listening. That way you don't miss out on new episodes. Head to wiserinvestor.com and reach out if you have any questions. We would love to hear from you. Today's episode was produced and edited by Lilton Moore.